Right, hello everybody. This is Adrian Boothby here. I'm one of the directors of Trendsignal, and this is today's podcast for the 13th of March 2023. I'm joined with Jerry Miller, our managing director. Hi, Jerry.
Yeah, hi all, morning.
So what we're going to do today is take us through, well, it's quite a lot going on in the markets actually as it goes. So big crash on really Thursday and Friday in the stock market, a lot going on in the banking sector, a lot going on with interest rates as well, Jerry. So could you just give us a bit of a run through of what's happened?
I'll tell you, there's a lot gone on, Adrian. So here we go. Take a deep breath. So last week we were preparing for Jay Powell as the chairman of the Federal Reserve does a sort of semi-annual testimony to the Senate Banking Committee in Congress, and that's where he reports on what's going on with monetary policy, etc. And he basically said last Tuesday that the Federal Reserve would have to consider raising rates faster than what the market was expecting. And this was like, oh gosh. So instead of it being a quarter point hike, there could be a half point hike, and there could be more hikes by the end of the year, towards the end of the year. So that's really, and that caused interest rate expectations to spike quite a lot higher. So the year end, the highest interest rate for this year went out to 5.7% with no rate cuts by the end of the year. That was Tuesday. That caused the dollar to rally, caused bonds to stay. Well, they were relatively stable. Wednesday passed, Thursday passed, and we were aware of this bank called Silicon Valley Bank, or SVB, that was struggling. It lost a lot of money in a bond portfolio, and then it tried to raise some money and failed. Anyway, come Friday, the bank was put into administration by the regulators in the States. So this is one of the biggest banks a big bank in the US, Adrian. I think it's the 16th largest. So it had significant impact. A lot of tech companies in California deposited their money with SVB, and it was a big deal. And what that did, along with non-farm payroll, so not only on a day when the 16th largest bank was put into administration, we also had the non-farm payroll data out. So if you look at the bottom of the screen there, Adrian, you want to highlight there were three elements to it. Okay, that's the non-farm employment change, 311,000 jobs. Well, you'd think, hang on a second, after 504,000 jobs, which is slightly revised down from the previous month, that's not bad. That's quite strong. But actually, the market was more interested in the fact that average hourly earnings was falling. And you might think, what, 0.3 instead of 0.2 instead of 0.3? Is that a big deal? It is a big deal because it had been as high as 0.4. If workers have been paid less, but not only that, look at the employment rate as well. Okay, sorry, I'm jumping, Aidan. I do apologize.
No, that's fine. I'm trying to catch you. I'm trying to keep going.
Yeah, I know. But look at the unemployment rate, 3.6%. You might think, well, hang on a second. If we've had 311,000 new jobs, why has the unemployment rate gone up? More people joining the jobs market, more people having to go back to work to earn some money and looking for a job. And I think the market or investors, traders latched on to the negative components of the non-farm payroll data. And that's what really helped put the skids under, certainly put the skids under the bond market. In fact, bond markets rallied sharply. I don't think I've seen the yield on the bonds fall as dramatically as they did on Friday. And in part, it was also down to SVB. So when SVB Bank, there was announced that the regulators were putting it into administration, there was a big sort of flight to quality. And what we mean by flight to quality, Adrian, is that investors sell banks. They were absolutely petrified that there'd be other banks involved, and there were two other banks, one called Signature Bank. And there might be others still, and that's what the market's worried about. The banking regulator is worried about what we call systemic risk or contagion, or the problem from SVB spreading to more banks and then to the big banks. Anyway,
I think, Joe, just if I may, I think there's a difference between what's happening in the UK and the US with regards to SVB, isn't there? So in the UK, the UK division is being acquired by HSBC, but in the US, that's not the case, is it? It's being sort of their compensation scheme that's picking it up, isn't it?
Well, yeah, it's not shouldered by taxpayers in the US either. They've got their the deposit insurance scheme, and that's funded by the banks. And if that's drawn down to whatever extent, but you're right, the regulators over the weekend said that all depositors in the United States who've got money with SVB would receive 100% of their deposits back. That's quite a big deal. So that sort of calmed the nerves. Here in the UK, the SVB branch UK Limited of SVB was bought by HSBC with negotiations with the Bank of England, and that didn't involve any taxpayers' money or any involvement with any compensation scheme. And I think the reason why that could be done here in the UK and it's not so easy in the States is that the UK arm is a lot smaller than SVB in California. And so that was possible. So HSBC has just come along, bought the bank for £1, and all the deposits now are backed by HSBC, which is Europe's biggest bank. So if you've been an SVB account holder over the weekend, it would have been a particularly nervous time for you if you've got a lot of deposits here in the UK with them. But all is now sweetness and light, as HSBC are now your banker. So lucky you. But no, in the US, it's too complicated to be bought. There are too many dots to put and T's to cross to enable an acquisition to happen. And during any of those lengthy negotiations, even if it took as little as a week, the banking sector, the contagion risk would be so much higher. And I think the regulators just had to step in and say, no, we'll take it.
Yeah. So let's think then about interest rates, because that's been flying around as well, the expectations there. And obviously from Friday, forgetting SVB for a second, from Friday we had with that unemployment rate and the average hourly earnings. So why would that have an impact then on interest rates, Joe? Do you want to just explain? Because it's the average hourly earnings, isn't it? It's the 0.2%. It's the anti-inflationary element of that. Do you want to just explain a little bit?
Yeah, well, first of all, look at the bigger picture. Remember that unemployment or employment is connected with what the Federal Reserve are required to do. They've got two mandates. One is to maintain price stability, i.e. control inflation. The other one is to foster full employment. And you think, foster full employment? What their job is to make sure that everyone has a job. That's never possible in an economy because you've got to have a natural amount of unemployment for people to be able to move job. As far as the average hourly earnings is concerned, if people are taking home less pay per hour, it means they're taking home less pay per month, per week, and per month. That means they've got less to spend. If there's less to spend, there's less price pressure, and that then gives a little bit of comfort to the Federal Reserve in terms of how much they need to adjust the interest rates next week and in the months ahead. So a slowdown in average hourly earnings. So if people have been paid less, that has it tends to dampen down inflation.
Which is obviously one of the main reasons why interest rates have been going up so dramatically. So these two numbers here, average hourly earnings, unemployment rate, they really sort of have put the breakers on a little bit after what Powell said on Tuesday, wasn't it? So should we have a look at the Fed Watch tool just quickly so you can see here the changes. Joe, do you want to just explain what's on here?
Okay, so what we've got is, if you look on the top left hand, it says 22nd of March, and we're in that. We're looking at the data for the next meeting held by the Federal Reserve next Tuesday on the 22nd of March. This is what the market is expecting the Federal Reserve. Sorry, it's next Wednesday, by the way.
Wednesday, yeah.
This is what the Federal Reserve is expecting. This is what the market is expecting the Federal Reserve to do with interest rates. Currently, the interest rate's at 4.5 to 4.75. Do you see it says current target rate in the middle of the graph there at the top?
Yeah.
That's where it is at the moment. We're expecting interest rates.
I'm just doing a quick refresh just to make sure it is all up to date. Because obviously it's been flying around a lot. That's better. That's more like it.
Wow. God, that's even worse, isn't it? So currently there's a 62% probability of a quarter point hike. Let me just tell you something, Adrian. Before the SVB news last Friday, before the non-farm employment change, there was an 80% probability of a half a point hike next Wednesday. I mean, how this changes. We talked about this being very fluid. It's incredibly fluid. Now there's a 62% probability or 63% probability of a quarter point hike next week, but now there's a growing feeling that we won't get any hike at all. Goldman Sachs announced this morning that they do not expect the Federal Reserve to raise rates at all next week. That's a big call.
And I think it's just, it feels a bit like, because we had interest rates so low for so long, that, you know, such a move on interest rates like this is kind of something we haven't really seen that much of, or perhaps stop getting used to in a way. So this is quite a big deal, and this is one of the main reasons why we're getting such a huge amount of volatility in the markets, as you get a lot of repositioning of portfolios, not to mention obviously the banking contagion issue as well.
Well, yes, that was one of the reasons. That's what brought SVB down. They had a massive loss on one of their bond portfolios that they sold. I think they lost 1.8 billion or something. So all these banks that have got assets that from depositors, they're doing things with the those assets so they can generate enough revenue to pay the depositors. And some of these banks have got just pretty poor management, and I just don't think that they were managing their risk correctly, and to have a lot of exposure to the sovereign bond yields that have collapsed, or sorry, gone through the roof, which means the price of those bonds has fallen dramatically. It means these portfolios are losing these banks a lot of money.
Yeah. So I brought up the yields here, so you can talk about the change here, can't you, Jerry? Do you want to again just explain?
Yeah. So what we're looking at here, this is 3 different curves on what's called the U.S. yield curve. The US yield curve it tells us what interest rates are for 1 month to 3 months to 6 months, for 2 years, 5 years, 10 years, and 30 years. The key ones we're interested in is, first of all, the 2-year. It's called a 2-year note. If you want to hover over that, Adrian, you can then see what the interest rates are on those. The 2-year.
Yeah, sorry. Hang on a second. Yes, there we are.
That's the one. Yep, 2-year. Okay, last week, the yield on the 2-year went above 5%. It's very closely aligned to what interest rates are set at by the Federal Reserve. So when expectations last Tuesday went screaming up on where interest rates were going to go, so the yield on the 2-year note went flying higher. But by Friday, it absolutely collapsed. On Friday, we had one of the biggest falls in yields since 2008. And obviously, when you hear 2008, you're thinking about the Great Depression, the big, the big scandal there, all that systemic risk, and it sort of just reminded people that things can come around again. Anyway,
quickly,
so the yield now is 4.36%, just extraordinary. And that's literally in a week. Look at the 10-year. If you want to shift just a couple of bars to the left, to the right. So now the 10-year at one stage last week was about 4.05%. This is a big move, by the way. It's now 3.61%. It was at 3.7% at the close on Friday. So yields, bond prices are going through the roof. Yields are coming off. They move in opposite directions. So the price of a bond is inversely proportional to its yield. So if a bond goes down, if a bond price goes down, the yield goes up. What does that mean when yields go up? It basically means, well, you're getting more of a return on your money if you hold bonds, but the bond prices come off. And higher yields basically means higher inflation and higher debt funding costs to businesses. They don't like that. But this is not anything to do with inflation, Adrian. It's partly due to inflation, partly due to the non-farm employment data that we've discussed, but it's a lot to do with the contagion risk and this massive, what we call, there's a term called flight to quality. Investors are piling out of bonds and banks, I should say, bank stocks, and putting their money into bonds. Look what's happened this morning. You've got Credit Suisse down 10%, Commerce down 12%, ING down 7.3%, and I think the Eurostoxx banking index, that's down 6.4%. And likewise here in the UK, all the big banks and the FTSE 100 really hit quite heavily. And I think it just goes to show you, no developed economy is entirely insulated from the problems that's happening in the US and specifically with SVB and Signature Bank. So
absolutely,
it's very fluid though.
And one of the things we talk about flight to quality is often we talk about likes of gold. I mean, obviously that's risen quite a bit over the last sort of 2 or 3 days, isn't it?
Yeah,
As well. I mean, that
yeah.
was one of the few markets up last week, I would say, because most of the indices, obviously, and some of the commodities, likes of oils and so on, they got pretty hammered, didn't they? Down 3-4% across the board,
Yeah,
basically.
yeah. And we had our biggest falls in equities for 6 months on the S&P, and the Nasdaq. I think it was one of the biggest falls on the week for 4.5 months. So, yeah, that tells you a story, doesn't it?
Absolutely, absolutely. Okay, so for traders then, for the coming week ahead, Jerry, we need to be sort of thinking about that, I think. So we know a bit about what we've seen. What don't we know yet? What do we need to be aware of for the week ahead?
Okay, I just key data, inflation data on Tuesday. This is absolutely key, especially ahead of the Federal Reserve next Wednesday. So
Yeah.
that's core CPI. That's the one we're going to be focusing on core CPI. That's the one that's the, how can I put it, the endemic inflation, the one that is the stickiest. That removes the elements that have caused the headline inflation to go screaming higher, the likes of energy, oil, gas, and obviously food as well. They remove those components, so they've got something a little more that reflects proper inflation, and that's what the core rate is. And it's expected to be the same as last month, plus 0.4%. You'll notice that the headline is actually coming back from 6.4 to 6%, but it's the core rate we're interested in, Adrian. Sticky, persistent inflation is the bigger worry for the markets. And that's the data that we're really looking for.
So really, from a trader's perspective, I mean, core CPI can have an impact. It's not always the most impactful item of data. We're going to talk about that a bit later on, but it's going to be a pretty important one this week, isn't it? So specifically this week, because of what's happening, if it comes in away from 0.4%, you're going to have to expect some quite big moves on the dollar and on equities as well, surely.
Well, up until the banking sector problems last Friday, CPI was everything. This is what has been driving expectations about further rate rises this year. We had that start to the year when everyone thought interest rates were just going to go up another 0.5%, and that would be it. And then we'd have interest rate cuts at the end of the year. But that's changed because inflation is a lot stickier than expected. And now you've got the fact that there's a possibility of some sort of banking contagion issue in the US, and possibly that could spread to Europe, and that's going to cause the Fed to just not even raise rates at all now. But inflation, it would be a real dilemma for the Federal Reserve, Adrian. Can you imagine if inflation, if the core rate comes in at plus 0.6, what do they do then? They've got inflation taking off, and they've got the banking sector causing a problem. I suspect they'll take more note of the banking sector and just gulp and just put their head in the sand over the inflation data.
Yeah, I would think you would think so. Okay, so there's quite a few other sort of major events. So time-wise, we'll move on. But
sure.
Clearly, if you're going to say one next biggest item of data the following week is what, Jerry?
Well, you mean this week? It's got to be the It's got to be the ECB's monetary policy meeting on Thursday. We've got another 0.5 point hike in the what's called the refi rate or the refinancing rate. Just remember, the ECB was very late to the party. Certainly here, the Bank of England was raising rates well before the European Central Bank woke up and smelt the coffee. The US as well. As was already hiking rates. So the European Central Bank is playing catch up. So 3 to 3.5% is the least they can do, and there will be more to follow. There is a press conference half an hour after the announcement that will be quite keenly listened to, and it'll affect the Eurozone and UK equity. Well, Eurozone equities and bonds, and to a lesser extent UK and US equities and bonds, but pretty sensitive to that announcement.
I mean, how sensitive to the impacts of, say, core CPI in the US do you think European interest rates might be? Are they just going to be looking just purely at the European numbers, or are they going to take a view on what's happening in other areas of the important economies as well?
I know what you're saying. It is the inflation, the core inflation rate in the US. If that is sticky, does that make ours sticky? Does it make the Eurozone inflation rate sticky? Not always. I think people have certainly tried to imply that we have the worst inflation rate here in the UK. We've got the worst growth prospects this year, and I think the UK has really outperformed expectations, certainly from 3 months ago. But what happens in the US definitely affects what happens here, Adrian. So
Yeah.
if the CPI data was really strong and really put the skids under equities again, that's going to affect the FTSE, that's going to affect the DAX, that'll affect the CAC. There's no two ways about that. They're all connected. They all compete for capital.
Yeah, absolutely. Okay, Jerry, that's great. I think we'll leave it there. Thank you very much for the review, and we'll catch up with you again next week. That's great. Thank you.
Okay.
Good. Okay, so there's a couple of things I wanted to cover off on. One of the things that we like to do in these sessions is just talk about sort of the markets, what we should be trading. I think it's quite obvious, really, that as traders, what we're really interested in is volatility and movement. We're getting all of that at the moment. So actually to be focusing on one particular market, it's not probably quite right, because we're seeing those sorts of movements everywhere. One of the things we've been getting lots of trading opportunities on of late in the last few days and week or two is absolutely those indices. Gold as well, a buy trade there, loss-making trade from the 8th, though that's fine, you're going to get a little bit of that. But it's the indices where a lot of that sort of action is really coming through. We actually put a note out. We had some buy trades from around about the 3rd of March. We had quite a few of the index trades open. We closed a number of those trades out on the morning of the 7th of March, and that was great timing actually, just before Jay Powell came in and put the skids on the market. So that was nice. We locked in a bit of profit there. And I think this is kind of the point with it at the moment, is that these markets, using the term that Jerry mentioned before, fluid, there is an ever-changing picture that is happening right now. So if you're looking in there in your positions, you got a bit of profit in there, be nimble with it, is what we would think and what we believe. So look at the profit, look at the risk you've got on, look at the correlation, as we discussed in last week's podcast. Do think about looking to reduce risk where you can, because these markets can turn on a sixpence extremely quickly as well. So a couple of nice trades on some of the indices from Thursday night. We booked some really healthy profits on those, but like I said, don't be surprised if you see the markets spinning back the other way. So be mindful and look to manage your risk really as effectively as possible. And I look at that across, really all markets at this stage. That's going to be on stocks, it's going to be on foreign exchange, it's going to be on commodities and indices as well, everybody. Good week though, and a good month in terms of performance so far for March. The Trendsignal Plus program, the D1 Sniper strategy, up around about 10% so far this month. So really happy with that. That's looking to risk 2% of your account on each trade. That's the basis for the measurement there. But that's been a broad sort of mix of Forex and indices, mostly picking up the profits from there. Very few trades are open at the moment. So one of the other things I wanted to bring in and talk about today is kind of what's the problem that a lot of traders face, is trying to look at what the most important data items actually are. So in this section of the podcast last week, we talked about the impact of correlation and how we might deal with that. We talked about that was a relevant point. I did want to talk about this topic actually today and last week, in fact, in terms of news and events, but I'm going to talk about it this week because correlation was pretty important to us at that stage. So what is the problem? The key problem for me, for a lot of traders, is knowing which events to be aware of and which events are likely or could well have a big impact on their trading. So what I'm going to do is just quickly flick over to the economic calendar. We're not going to be long on this. This is a 2 or 3 minute feature just to make sure that we're fully aware of what we need to be thinking about. So we looked at the economic calendar earlier. There are plenty of calendars around. This is the Forex Factory one. When it comes to economic data, there are really 2 main items of data we have to be really keen on. Don't get me wrong that certain other items of data can come in and out of vogue depending on what's happening in the economic cycle. Inflation, CPI is going to be massive this week, but ordinarily the most important items of data are going to be interest rates, and they're going to be the non-farm employment change data that comes through on typically the first Friday of each month, although weirdly it wasn't. I think that was down to the bank holiday at the beginning, so that 27th of February there. So when we look at the most important items of data, it's going to be the central banks coming through their interest rate setting policies. So for example, this week 1:15 UK time, we've got the ECB setting their interest rates. So at the moment, it's expecting a 0.5% hike. Now, because that's massively important, it has a big impact on our savings, our borrowings, our mortgages, how much we're likely to go out and spend, and so on. That has a huge impact on pretty much all markets. So be aware of that. Particularly important on euro currency pairs. So if you're trading pound against the euro, or sorry, euro pound, or euro dollar, anything with the euro in it, it's going to be quite well affected, as well as European stock markets as well. So be super mindful of that. One of the things a lot of traders might want to do is reduce or close positions down ahead of that data. Be aware of the timing of some of the data this week, by the way. US changed a lot of the US data in particular. They had their daylight savings change on Sunday, so a lot of the US data is happening an hour earlier than it might ordinarily do. So that's one important point, interest rates. If I move through to next week, you can see that there are a few as well. So normally it's at 7 p.m., but at 6 p.m. on March the 22nd, we've got the US interest rates coming through, being announced there. And then the following day, we've got Swiss rates there, Swiss franc rates, and of course the pound as well for the Monetary Policy Committee as well. So these are going to be two massively important items of data. So whenever you're looking at trading, if you think about what's the most important thing, what have I got to be most aware of? There's too much data here to be too concerned about everything, in my opinion. If you're a day trader, yes, be aware of it. An end of day trader, be aware of the most important, the highest impact items. At the moment, yes, inflation, but ordinarily interest rates and non-farm employment change have the biggest likely impact on the markets. Like I said, typically the first Friday of each month, but in this case, it was the 10th of March there. Why? For exactly the reason Jerry said before, because in the US, the Federal Open Market Committee, they have two mandates. Number one is to control price stability. Number two, to foster full employment. And that's why their job data is massively important. So that's it, really. I'm going to call it an end to this week's podcast there. So thanks, Jerry, for being with us today. I wish you all the very best with your trading, and hopefully you'll tune in with us next week. Bye-bye for now.